For most people, the idea of becoming wealthy feels strangely disconnected from the reality of everyday life. They hear stories about millionaires, see headlines about successful investors, and watch financial markets create fortunes that appear almost overnight. Yet when they look at their own savings account, the gap feels enormous. What often goes unnoticed is that wealth accumulation does not behave in a straight line. The process is uneven, slow for long periods, and then increasingly powerful as time, capital, and compounding begin working together. This is why the journey to the first $1 million feels dramatically different from every stage that follows. Imagine two people standing on opposite sides of a valley. One person has already accumulated substantial assets while the other is just beginning to save. From a distance, their financial situations may appear separated by only a number, but the mechanics underneath are completely different. The person starting from zero must create habits, build systems, develop financial discipline, learn how assets work, avoid costly mistakes, and generate the initial capital required for investing. The person who already owns productive assets has something entirely different working in their favor. They have momentum. This difference between effort and momentum explains why the first phase of wealth building often feels frustrating. During the early years, financial progress depends primarily on human effort. Income comes from time, skills, labor, or business activity. Savings accumulate slowly because each dollar invested represents a dollar that was earned first. The investor is effectively carrying the entire weight of the process. Every increase in net worth requires intentional action. Psychologically, this period can feel discouraging because human beings naturally expect visible progress when they exert effort. If someone spends an extra year improving their career, negotiating a better salary, reducing expenses, and investing consistently, they often expect dramatic results. Instead, they may find that their net worth increases only modestly. The effort feels large while the outcome appears small. This creates a dangerous temptation to abandon long-term strategies in favor of shortcuts, speculation, or constantly changing plans. The challenge is that compounding rewards patience long before it rewards wealth. Most people understand the concept intellectually. They know investments can grow over time. What they underestimate is how little compounding appears to do during the beginning stages. The growth curve starts almost flat. This creates an illusion that nothing meaningful is happening. In reality, the foundation is being built underneath the surface. Consider a simple example. Imagine an investor contributes $10,000 annually into a diversified portfolio, earning an average return of 8% per year. During the first year, investment growth contributes only a small amount relative to the contribution itself. Even after several years, the majority of the account value comes from money that was deposited rather than money generated by the assets. The investor remains the primary engine of growth. However, something subtle begins to change over time. As the account grows larger, the annual investment gains begin to increase. Eventually, the portfolio generates growth equivalent to several months of contributions. Later, it may generate growth equal to an entire year of contributions. At some point, the portfolio starts adding more value than the investor personally contributes. This moment represents a fundamental shift in the wealth-building process. The mathematics behind this transition are surprisingly powerful. Suppose a portfolio reaches $500,000 and continues earning 8% annually. An average year would generate approximately $40,000 of growth. If the investor contributes $10,000 during that same year, the majority of new wealth comes from the assets themselves rather than from personal savings. The balance sheet has started producing meaningful output on its own. This is why many investors describe the first $1 million as the hardest milestone. The difficulty is not merely psychological, it is mathematical. Reaching that level usually requires years of building financial infrastructure before compounding becomes visibly dominant. The investor must survive the longest period of delayed gratification. There is another layer to this process that often receives less attention. Wealth building is not solely a mathematical challenge. It is also an identity challenge. During the early stages, many people continue seeing themselves primarily as workers who invest. Their financial future depends largely on what they earn next month or next year. Their attention remains focused on income because income feels immediate and controllable. As assets grow, a subtle identity shift begins to occur. The individual gradually becomes an owner of productive systems. Stocks represent ownership in businesses. Real estate represents ownership in income-producing property. Private investments represent ownership in economic activity. Instead of relying exclusively on labor, the investor begins participating in broader systems that generate value independently of daily effort. This shift changes how people think about time. Workers are naturally focused on short-term cycles because paychecks arrive frequently. Owners become increasingly focused on long-term cycles because asset values compound over decades. The same individual who once measured progress month by month begins evaluating opportunities across years and even generations. Real estate provides a particularly useful example of this principle because it combines several forms of compounding simultaneously. Rental income can increase over time, loan balances can decrease through amortization, property values may appreciate, and reinvested cash flow can be directed into additional assets. None of these mechanisms typically create dramatic changes overnight. Their power emerges through consistency and duration. Historical examples reinforce this pattern. Many of the world's largest fortunes were not created through sudden windfalls but through long periods of ownership. Business founders, real estate investors, and long-term shareholders often experienced years where progress appeared modest, before reaching a point where accumulated assets began generating substantial wealth. The public frequently notices the outcome while overlooking the decades of compounding that preceded it. Behavioral economics offers another explanation for why the first million feels so difficult. Humans tend to evaluate progress linearly even when outcomes are exponential. We instinctively expect equal effort to produce equal results. Compounding violates that expectation. The same action repeated consistently can generate dramatically different outcomes depending on when it occurs in the timeline. A dollar invested early and a dollar invested late are not economically identical because time itself becomes a multiplier. This mismatch between human intuition and financial reality creates many common investing mistakes. People abandon strategies too early because growth appears slow. They chase recent winners because steady accumulation feels boring. They underestimate the value of consistency because the benefits are delayed. In each case, the underlying issue is a misunderstanding of how compounding unfolds through time. The irony is that the stage that feels least rewarding is often the stage that matters most. The habits developed while building the first $100,000 frequently determine whether someone eventually reaches 1 million. Discipline, patience, risk management, and consistent investing are easier to establish when balances are small than when large amounts of money are involved. Viewed from a broader perspective, the first million is not important because of the number itself. Its significance comes from what it represents. It marks a point where accumulated capital has become a meaningful economic force. The investor is no longer relying entirely on effort to create growth. Assets have begun sharing the workload. This is why wealth creation often appears slow and then suddenly obvious. The reality is that the process was working the entire time. Compounding simply reveals its results unevenly. What looks like overnight success is frequently the visible outcome of years of invisible accumulation. Understanding this changes the way we interpret financial progress. Instead of asking whether results seem impressive today, we begin asking whether the underlying system is becoming stronger. Instead of focusing exclusively on income, we focus on ownership. Instead of expecting linear outcomes, we learn to respect exponential processes. The mathematics of wealth have always rewarded patience, but patience becomes easier when we understand what is actually happening beneath the surface. The first million feels impossible not because the mathematics are working against you, but because the mathematics have not yet had enough time to fully reveal their power. Once that transition begins, the challenge gradually shifts from building momentum to managing it wisely. And that distinction explains why so many investors describe the first million as the hardest one to earn.